When it comes to stock investing, one of the most important aspects to manage is your own psychology and your emotions. In order for this to happen, it is really important to understand the overall psychology of the market as well as the individual emotions and different cycles that happen for the market as a whole and also for individual stocks. In this video, I'm going to share with you an overview of the stock market psychology, providing you with the information that you need to know so that you can stay rational during different market cycles and be able to make good investment decisions no matter what other people are saying and what the sentiment is in the market. Okay, so as I mentioned before, we're going to talk about the psychology of investing in the stock market, but also what I want to do, because I have a little presentation prepared, is show you some practical ways to be able to benefit from the different cycles that are constantly occurring in the stock market. With that being said, let's go right into the introduction. So stock market psychology is the study of the emotions and the mental processes that drive investors' decision making in the stock market. It is very important to understand this concept because we as humans are emotional creatures. Most of our decisions, if you really think about them, they come from an emotional reaction, an emotional feeling that drives you to take certain actions. And if you're not able to control those emotions properly, particularly when it comes to money, you can get really screwed up. And the reason why is because you're going to make bad decisions that are going to lead to your portfolio going down in value over time. And the reason why is because you're going to make the wrong decisions that are going to lead to your portfolio going down in value over time, which is the absolutely worst case scenario. The best way to stop yourself from being prey to these different emotions of the market as well as yourself and make bad investment decisions comes directly from awareness. You see, once you become aware of something, it's a lot more easy to spot when something's happening and to do something about it. So here in this graphic, you can see some of the most important emotions that drive different cycles of the market. So starting off, we see disbelief. And this is that after the previous losses that happen in the market, the fear of losing additional money is just too strong and everything starts to go down. So there's this dip that you can see right here. And then all of a sudden, because of that, different people start to invest in the markets again, particularly smart money. So these are smart investors that understand these cycles and they want to take advantage of these opportunities. And then overall, people get into a state of uncertainty where they don't know what's going on. Should they enter the market? Should they exit? If they took losses here and the market went down, should they just get rid of some of the losses that they took or whatnot? Then after that, the market keeps going up, and then there's optimism. This is where everybody wants to get in the stock market. This is where the news is like the stock market is reaching highs that we've never seen before. This is amazing. People are talking about the next bull cycle and how amazing things are. And then this just keeps fueling the enthusiasm of people to invest and invest and invest. And also, as people see the gains that others have made in the market, they get even more compelled to put their money into the market, except of course they're doing that when the market is very high. Then after that, there's the euphoria where if you invested here and you go all the way here, you're going to be absolutely ecstatic with the returns that you're making. You're going to tell everybody about it, and that's going to fuel even more people investing in the stock market, as they may have some jealousy or they may just want to get the same gains that you have. And then inevitably, as everything that goes up, it goes down. So here you have the market going down, but people still have that confidence that there's going to be a bounce back, which there inevitably is. It's just a matter of like keep going through the cycle, and perhaps that will come after many other years. Then after this, there's even more losses, so anxiety starts to kick in, like, man, like I lost all this money already. What should I do? Should I sell right now? Should I wait for a bounce to happen again? And things go down even more. Then there's denial. People can't believe that the market was this high and now it's this low. Some people sell, some people lose a lot of money, and some people, they're just in denial and they refuse to sell and take those losses. After the market goes down even more, then panic starts to kick in, because we were at this highs even before we were higher than what we are now. So people start panicking and everybody rushes to sell. Then here there's the capitulation, where everybody just accepts the losses. Hey, you know what? I didn't know what I was doing. I just followed what my neighbor was doing, who made a lot of money during this euphoria stage. And now I'm just going to take the loss, take it like a champ, sell my stocks, and then just accept it and go from there. The losses just keep going and the market just kind of stays flat, and then agony kicks in. So this is where people start to resent what happened, and the emotions really start to kick in. Like, man, I really lost out on this money. I could have gone on trips, I could have gone on vacations, I could have bought XYZ instead of investing in the market and take the losses. And then lastly, after that, the depression cycle kicks in, where inevitably people have that depression. You know what? I'm not going to invest in the market. This is not a mistake that I want to do again. So things are start to go flat. And then inevitably, as that happens, people start to spot opportunities to invest again. And then the cycle keeps happening over and over and over. The interesting part about this is that I just took this chart. This is the S&P 500. I took it from Yahoo Finance. Is that you can see right here exactly the changes that you can see right here. So this is kind of like one cycle of the stock market, and you can see if you look over time, there's these cycles that are happening all the time. So there's the mini cycles, which you can see right here from up down, and you can see this happening over and over. This is a big crash right here, and then we have the same cycles happening over and over. So there's kind of micro and macro cycles. The macro cycles tend to happen about every 7 to 10 years. The micro cycles, they can happen all the time. So you can see this pattern, and this psychology literally applies all the time. It's something that has not changed, and you can look at this data going back to the data in 1920s, and it's always been the same thing. So it's very important to be aware of these emotions and to not let yourself get swayed by, especially the ones that we're going to talk about in a second. So let's talk about the emotions that can hurt you the most as an investor, and then I'm going to share with you 2 different strategies that you can apply right now so that you don't let yourself get swayed by these emotions, and so that you can make good rational investment decisions that are going to make you proud over time. So the first one is the fear of missing out, also known as the FOMO, and this is basically the fear that allows many investors to make bad decisions. And this is caused because people don't want to lose out on opportunities, they don't want to look bad in front of others, and so they make bad impulsive decisions without doing research and really understanding what it is that they're investing, what their strategy is, what their exit plan is. And so this inevitably leads to bad outcomes. That's number one. Number two is the herd mentality. Everybody to some sense wants to fit in. They don't want to be left out. They don't want to have losses or just not be as smart as other people. So if they see that other people are investing in the stock market and getting rich, everybody wants to get in on that opportunity because they don't want to be left behind. And this again feeds into the FOMO and allows you to make bad investment decisions, because the problem with this emotion right here and with this tendency is the fact that it blinds you to the fact that you're just making a decision without doing proper research, without really understanding what it is that you're doing. And if you do that, at that point it becomes a game of luck. You may be lucky, make some good money, or just more likely than not you're not going to be lucky and you're going to lose money. There's 2 more emotions before I get into the actual strategy. So this one is greed and fear, and these are very powerful emotions. People want more stuff. People don't want to be left behind. Another one that I would add that fits right into this category is jealousy. So when you see somebody doing better than you, you want to be better than them because you know that person and you're like, hey, you know what? I know that person. They're not that smart. Why are they making all this money in the stock market and I'm not? I better get in on this. So these emotions are really critical to keep in mind, and it is important to have the right strategies and the right mindset, which you're already getting by watching this presentation, so that you can avoid them. The last one is confirmation bias, and this is that once you get an idea in your head, it is very difficult to get rid of that idea. And the reason why is because you constantly seek information that validates the idea that you have, as opposed to information that says your investment strategy, your investment ideas are wrong, here's why. So this becomes a really bad cycle because you believe something, so you believe that you made a great investment, and you keep believing that, and you believe in that more and more strongly, even when new evidence suggests that this is not the case. So you stick with it, and as you stick with it, more and more losses happen to your portfolio. So with that being said, the best way to avoid this irrational emotions and tendencies is to have a really solid approach to your stock investing. And one of the best ways to know what works is to look into the past to see what has worked and has stood the test of time. So one of the things that has worked very well is to index. So as you can see, here's a graph, and over time you see that the stock market has the tendency to go up. So as long as you index and you do it on a consistent basis and you stay long enough into the market, you're gonna generate very good returns. In fact, you may generate returns higher than you would with other asset classes such as bonds or just leaving your money in the bank. So this is the basic strategy that you can apply, and the way that you can do this is just invest into ETFs that follow indexes. So in this case, we're looking at the S&P 500. An ETF that you can invest in is VOO or the SPY, and this allows you to follow the direction of the index and benefit from this. This is quite powerful because it takes away all the emotions. You know what? I'm going to invest this much money every single month into these particular ETFs, and I'm not going to touch the money until 10 years from now. So 10 years from now, then you're out of the cycle, and now that you've seen that you will reap the rewards. So this way you take all the emotion out of it and you really think rational about what you're doing. Now the S&P 500 is not the only index that you can look at. There's so many other indexes and ETFs that are worth looking at. I'm sure that you can find them on YouTube. This is just an example. Now the other strategy that I'm going to share with you is if you want to take your investing a little bit more seriously, this is going to be very powerful. The last strategy, if you want to take matters into your own hands and be more active with your stock investing, is to look into value investing. And value investing is one of the most successful strategies for investing over the long term, something that investors like Warren Buffett, Charlie Munger, and even Joel Greenblatt, amongst many others, have taken advantage of to grow their wealth exponentially. The way that value investing works is very simple. Rather than looking at the stock price for a particular company and looking for trends and what people are feeling about a particular company, what you're looking at is a company. A stock is essentially a piece of ownership of a particular company. Therefore, if you can find the value of a particular company, then that's all you need to do. Because if you, for example, are analyzing Apple right here, or let's say we change it to Microsoft. If you do research into Microsoft and you determine that the price for Microsoft, let's say, is $20 per share, and right now the stock is trading at $10 per share, that's how you know that you're getting a good deal and that you should invest in that particular company. So that is the whole art of value investing, and there's many videos that you can check out on our channel in terms of valuation, company research, etc. But there's also a lot of great content on YouTube that you can check out. And the great thing about this approach is that you're looking at the company itself. What is the value of the company, as opposed to how people are feeling about the company. So you're always staying rational, and as long as you will withstand the different cycles of a particular stock price, you are likely to benefit over time, and you're going to be able to take advantage of other people's emotions, because when they're getting emotional about a particular stock, selling, the stock price is going to go down below the actual value of the stock, and then you're going to be able to buy at that price. And then when people realize, hey, you know what, this is actually a really good company, is worth more than the current price, that's when you're going to be able to benefit and sell higher than you buy for. Now you understand stock market psychology at a high level and how to use this information so that you can avoid bad investment decisions and generate consistent returns for your portfolio over time. If you've enjoyed this video, make sure to subscribe and turn on the notifications on, so that way you get notified every time we release a new video like this. That's going to allow you to take your investing game to the next next level. I'll see you in the next one.